we got a couple of people already here watching us. We're live right now, so we're live company-wide. We're live on Facebook, so you have a large audience watching you and wanting to hear from you. So I know you've been a part of these before. What we do first is to go over a couple of house cleaning rules, a couple of information, and then we're going to start grilling you on live on questions. The big topic that everybody is talking about this week is this coronavirus, and I think we are all concerned, and we should all be concerned. But I think that there's a lot of precautions and methods that have been put out that if we all follow them, they will be able to get through this as a country and as a planet without further ado. But the world keeps going, the economy keeps going, your life keeps going. So I like to say to everybody, hey, it's you gotta, and that was what I posted earlier today. You gotta put your fears in place, and you gotta put a head on and focus on what you gotta do. So the reason we brought Ruben on, and we were supposed to have him last Friday, but there was a change, was because mortgages. We headed into 2020 with already a very robust cut on mortgage rates, and then this started happening, and the rates sort of took a dive, but then they moved up, and it's been interesting to watch. What's been happening out there. I mean, for those that know me, this is my 26th year on this industry. So I mean, I was here when September 11 happened, and we came back stronger, healthier, better. I was here during the 2008-2009 crisis, and we all survived that and kept going. So now we're going through another market restabilization, if you want to call it that. But mortgages, even in those two, were never where they're at today. Coming out of the September 11, although there was several cuts and moved by the federal government, rates maintained themselves north of 5.5, bordering on 6.5. During the financial crisis, rates were still at the high 4s to 5s, right, Ruben?
Yes.
And then they creeped up to 6, and here we are this week with rates on the 3s. So what can you tell us about what's happening in the mortgage world in the past 2 weeks? And I know that's been a very exciting 2 weeks to watch.
Well, it has been exciting. Thank you, first of all, for inviting me on. I appreciate it. Yeah, it's been a kind of whirlwind, very, very educational for all of us, right?
Yes.
Never got to the point where, never thought we'd get to the point where we're at now. But again, let me just reiterate your comments. Everybody just do what you're supposed to do, what they require you as far as staying safe. And we've gone through worse, I think, before, so we'll get through this one also. To the matter at hand, the stock market continues to, as of yesterday, it's actually a little bit up today, about 500 points up today. So that has a big effect on what we do economically, period. But the main reason that the rates started going down last week, beyond the coronavirus one, there's two other factors. One is what happened with the OPEC and the price of oil. We had an issue where I guess Russia and the Middle Eastern countries are going at it a little bit, and that put some pressure on the markets. And also, because even today, the U.S. still considered a safe haven for money and for investment. A lot of that international money comes more and more into the U.S., and it typically comes in the form of bonds. So typically what guides us is a 10-year bond. That's always what we're looking at. Even though we sell mostly 30-year mortgages, it's the 10-year bonds that we really focus on, and that's what our pricing is typically based on. So as the international money came into the U.S. last week, looking for safe haven, something a little more secure for them, it starts pushing the prices of these bonds up and the yield down. In other words, a lot of money chasing less and less bonds.
Let me. I want you guys, because what he said is critical. What Ruben just said is critical. You need to look at it that way. the entire planet decided last week that the safest place to park their money was in the US. And this is what I call the smart money. Not the amateur investor, the smart money, the sovereign funds, the people that run the economies for other countries looked at the US and said, this is the safest place in this moment of turmoil to park our money. So when you look at the American economy going forward, you got to have that same faith that the sovereign fund of Denmark had by putting trillions of dollars into the US bonds. So you got to have that same faith and confidence that the whole planet has in our country. No matter what party affiliation you have, we're all one right now. And you got to think that everybody's looking at that. So that's why the bonds, took the dive. But how does the high demand on dives and bringing down the yield, how does that translate, Ruben, into rates for the agents watching us right now?
So for the last few months, that's been happening just in general. So the bond market price has gone up, the yield has gone down, and our rates have been slowly decreasing for the last couple of months. Not what we expected in 2019, but we got it nevertheless. And now once the 2 weeks ago when the coronavirus kind of, let's just say, put fuel to the fire, and more alarmists, obviously this started abroad in China and in Europe, and again, so more money came in, more money left the international world and came into the U.S., further pushing these bond prices up and yields down. So the yield went down to the lowest I saw, and I don't have the data in front of me right now, was around 0.04.
0.32. It actually touched 0.32.
Okay, so 0.32 is what it touched. That was the lowest point. Just for comparison's sake, we had been most of the year at 1.7 or so, 1.8, 1.9, 1.6, kind of fluctuating that, and all of a sudden we took a very big hit on the yield. So what that does is create, part of it's good because the money's coming in, so you have an investment in the U.S., but it also brings down the profitability for a lot of these funds. So although we based our numbers on the 10-year bond, we are and not just us at CMG, but all mortgage companies, all lenders that sell these loans in the secondary market. A lot of the money that they make is not so much on the rate, but on the servicing rights. So while you're seeing a lot of refinancing going on right now, one of the reasons that many companies are like us, which we typically not only do purchases, but mostly do purchases, we don't want to lose our servicing portfolio. We want to keep these loans in-house, not let them go refinance with somebody else. There is a maximum, or better said, a minimum that these rates would go. Now, we're kind of already started moving up. I just checked a little while ago. We're up, I think, at 0.9 right now. So the rates are definitely starting to move up. What ended up happening is quite simply it's a matter of economics. So although the 10-year bond was so low, we couldn't lend at that number. There came a point where it was not financially feasible, and by we I mean the industry, not just CMG. So they started creeping back up, also because of workload. I think you saw some of the biggest banks post that they just couldn't handle the amount of business they were getting on refis, and therefore started raising the rates to kind of push people away. In our case, we never did that. We always, focus on you guys, the realtors, first, and want to make sure we do our purchase business first, and then we actually allow the market to kind of take place. Right now, the reason that we're moving up a little bit on the rates, they're actually a little higher this week than they were last week, is because we have a prepayment risk. So we're not going to do a loan at 4% or 4.5% today, which is just going to refinance next week at 3%. Makes no sense for anybody, and that prepayment really costs us a lot of money. So it comes to the economics. What do I see in the future? Who knows, right? Nobody has a crystal ball, but the rates should creep up a little bit to a more stable rate. Somewhere in the high 3s, low 4s is probably where they'll end up. Assuming that it gets kind of managed, but that's kind of what we're seeing. Whether the bond market continues to grow, whether the yield curve continues to dive, that is pretty much a sweet spot. So between 3.5, 3.75, 4. That's where the rates are going to be, depending obviously on many factors like primary residences, risk factors on the property and also the person's credit score.
Okay. For everybody watching, and we have a good audience watching on Facebook, guys, take a moment, share this right now that is going live in your feed, because there's a lot of questions people have out there. So if you want to take the moment and go ahead and share this with everybody, we will appreciate it. But Ruben, there's based on something I was reading earlier today in Wall Street Journal. Once we reach that 4%, I think it's like 80% of refis are out of the spectrum, and we're almost at 4, right? So then so that rush to refinance, it's gonna go the minute we touch 4, right?
That's what they're expecting, but it's because of the way the coupons sell, and that's a class, not a webinar. Even if, for example, we would quote you a 4 or 4.25, it makes sense right now for somebody to pay half a point to us and get a 3.5 rate, or whatever it may be. I'm just using an example, and that's very important to see. So we're kind of actually in a point environment where it makes sense for somebody refinancing to buy down the rate or pay the points to be able to get a significantly lower rate. Historically, a point would buy you about a quarter a point. Nowadays, buy you a half or almost 3/4 of a point. It makes a big difference. So, like everything we're evolving to, we're coming up with new ideas how to benefit our customers and our realtor partners, whether it's, being able to come up with new products, or whether it's just a matter of, kind of old thinking where, hey, if the customer pays half a point, they're going to get, a point in rate. It makes sense to do that, as opposed to, historically, well, to make it, if they're only getting a quarter point in rate, it typically didn't make sense.
Didn't make it. Okay, so then that rush to refi, it's approaching, its heydays.
Yeah.
So you mentioned new products, and CMG is one of those lending companies that is very forward thinking. I mean, your GoFundMe tool, it's bar none, to me, an incredible way for anybody to buy a house. What new products are you guys working on? What do you see? So there's a big drive for first-time home buyers. What, if anything, are you guys working on for those first-time home buyers that are jumping into the market now?
Well, the home funded program, thank you. Yeah, that's we love that program. Is that, we noticed that although, prior to what's happened the last few weeks here, the economy was roaring, people had jobs, low unemployment, credit for the most part was better than it was during the crisis. That the main reason that people were not buying was that they just didn't have the money for the down payment and closing costs. A couple reasons why they didn't have the money was that the rental market's so strong, especially here in South Florida. It's expensive to rent. And also a lot of these younger first-time home buyer millennials had, very high student loan debt. So those two things coupled, their inability to actually raise funds. The home funded product gives them a crowdfunding option to be able to go to their fans, family and friends to help them crowdfund for down payment and closing costs. We as a company also contribute to their home funded account. Realtors can also contribute to their home funded account on the closing cost side. So, and it's done in their world. In other words, all kind of done online through social media, all done through the phone, pretty much bringing the product to them as opposed to having them to come to us. So you'll know that has been the biggest thorn, the money, where's the money kind of thing. It's all about the money. We brought it to them. And we believe that product is going to continue to grow just based on its need.
All right. Couple of questions I have got, and I know, for those of you that don't know Ruben personally, Ruben in his previous life was an appraiser and has been in real estate his whole career, from banking to appraisal to running CMG down here in South Florida. I'm getting a lot of questions, and I understand, because uncertainty creates panic. And you were here during the last correction about what this is going to do to our market. I like to look at numbers, and based on numbers, I like to make informed decisions. So Broward County right now, Ruben, and let's call this affordable housing. Only South Floridians will call $450,000 an affordable house. So right now, Ruben, all of Broward County, which is a big landmass, single family home, lot and block, there's only 2.8 months of inventory under 450. You know that we need somewhere between 6 and 8 to have a balanced market. And then you need 10 to 12 to begin to have a buyer's market, right? So that means our inventory has to quadruple overnight for that to happen. So what do you see in our market, and what do you see in the with banks? Are banks going to have the appetite to continue lending during this this upcoming months, or because I mean, to me, I just look at, if there's no inventory, population is still going to increase, households are still going to be created, people are still going to be moving to South Florida. This might be a small disruption in plans, but I mean that will be it. Yes, is unemployment going to uptick in South Florida? Yes, but to me, that those are listing opportunities. Those will be, listings now going to be properly marked values. And at the same time, people that were not thinking about moving because of change in jobs are going to be thinking about selling. So how is CMG prepping to handle this uptick in market that I see coming up, on opportunities that I see coming up?
Well, we have a couple of things going for us right now that we didn't have back in 2007, 2008. Number one is, we've had very tough underwriting guidelines for the last many years. So we don't have the speculation that we had back in 2005, 4, 6, where you had people buying 3, 4, 5 houses at a time and they were sitting vacant. Most homes are primarily occupied for their own living needs. So more people are less easy to give it up or make a decision based on that. I will tell you that one thing I learned from the 2008 recession was that numbers don't lie. Sometimes you feel certain things, or you think, well, I kind of know through experience. The numbers don't lie. Numbers always seem to find a way to pan out. So what you're saying is really what you got to be focused on. The inventories are so level, and while they may increase now because of this situation we're in now, the underwriting guidelines that have been in place the last few years, plus the fact that we have two very, very large things helping us here in Broward County, and that's the beautiful Atlantic Ocean on the east side and the huge Everglades on the west. There's no more land to build. So they're either going to build up, like we're seeing with the condos, or I think our inventory levels will be stable. Right now, the fact that they're shortened, that's why you're seeing the increase in prices. But once they get back to some point of stability around that 6-month normal ratio, I think you're going to start seeing some more availability, like you said, for some more affordable homes, if that's the correct word, at 450.
Yeah. Yeah.
So at that price range, the changes were made last year to FHA loans and even conventional conforming loans, raising the amounts that we can to lend. So if those homes become available again, we have plenty of product to share with.
Okay. So another question that I'm being asked is, since you were here in the last correction, what does it look like? I had a conversation yesterday with Joaquin, and I said, this December, when we're sitting down at the Christmas party, we're all gonna have a drink and say, wow, that was an interesting start to the year. What, if anything, are you guys doing differently this next couple of weeks to mitigate, the situation right now?
Well, I mean, just starting with our employees, most of our employees work from home anyway, so we're doing a little bit of social distancing as far as the virus. But again, I mean, we're all becoming somewhat of an economics expert. Some of the stuff that we didn't think about, like coupon rates and yields and bonds, and these are words, before they used to just ask you what your credit score was. Now we have to become much more educated, and that's kind of what we're doing. The company as a whole is putting out updates every day, sometimes 2 or 3 times a day. We're repricing continuously. I've never seen us reprice 3 times in a day. We've repriced 3 times in the last 3 days. So Our secondary market is run by a great guy, and he really is on top of it, making sure that we're giving your customer what the correct rate for them, and then makes sense in the market. So we're working. I mean, you may not see us that as much, but everybody's working, busy, and staying in tune with what's going on with the market. This is one of those things that we're just going to have to kind of wait and see what happens, long term. But this too shall pass, as the saying says, right?
So and CMG is a very tech-driven company. I mean, you can literally do the entire process from the CMG app, which you can even get customized and branded to yourself and ULO, right, Ruben? And you can share that with your clients, and if you wanna touch base on that.
Absolutely. We have our app is completely self-reliant. They can apply for the loan right on their phone. They can send documents on the phone. We typically like to use our realtor contacts added to the app, so they would keep track of what's going on in the process of the loan process. And obviously, that's a big benefit for us nowadays if we can't see somebody in person. Even before this, I mean, we're closing most of our deals. We don't meet the customer in person. Maybe 90% of the time, it's all done electronically.
What is timelines right now? Since you at the beginning you opened up with some of the larger banks took a larger bite of the refi market, and now they're trying to chew and swallow. What is your timelines on an FHA, on a conventional for from application to closing date?
So on purchases, we're meeting our closing dates. That's our number one thing, right? We're still prioritizing purchases. We're actually asking our loan officers to lock refis for 45 days. So they are definitely taking a backseat to the purchases. We know that 3 months from now, 6 months from now, a month from now, when this all kind of goes away, that Ernesto Vega and Canvas is still going to be there. So we want to make sure that your deals get done and get priority, more so than the refis. That being said, we're closing quite a few refis ourselves right now. But yeah, we're meeting our closing dates. I mean, as you know, we just got a clear to close on one yesterday that a bank tried to close, and we were able to do it in about 3 weeks. So yeah, so now on the purchases, we're meeting our closing dates. Obviously, talk to your loan officer if it's a kind of an easier file that we can kind of get through quickly. We will, but we're sticking to meeting those closing dates and those commitment dates, and everything is basically standard as far as purchases go.
Okay, so then, if someone needs a 17-day FHA, it can still happen.
Well, it happen, but I ask you guys to please give us 30 days.
you notice he got nervous there for a second. No, I'm saying that because they just did one of those for us, and it was a sticky one to begin with. But they knocked it out. They knocked it out on 17 days. So we are. I mean, we're trying to emulate giants like you guys. So we're big about tech when it comes to to communication, for documents with clients and with you guys. We're big about Zoom. I communicate a lot with a lot of our agents and clients to this incredible platform. So in this trying times, when people want to have a face-to-face conversation, something more than just a phone call conversation, they want to see the other person. We're big on Zoom. So I mean, to everybody that's watching, this is the time to implement that tech that you have. I think it's something that will come out of this out of this situation. Is I think you're going to see a lot more remote working environments, a lot of more virtual working environments. A lot of people adapting this new technologies, this electronic signing, and all of this stuff. Ruben, this is something from your previous life, and I think Fannie is about to approve it. This new virtual appraisals based on data that they have, without even seeing the interior of the house. Is that really where we're heading to?
Yeah. We're already getting appraisal waivers on files. So based on the risk of the file, credit score, down payment, they're already We're already seeing it, even here in South Florida, which typically we lag on that kind of stuff. But yeah, we're already seeing the
That's a huge savings to a buyer.
It is a huge. Well, it's your standard appraisal is $450. I mean, that's a lot of money. Um, now, I'm not saying it's going to happen on every file. I've heard of actually just having inspections done from non appraisals, the appraisers and the appraiser sitting kind of like what you said about the virtual world, sitting at his desk and kind of going through the comps and coming up with a value. I'm not sure how that's going to affect us, how we work together with you guys on the contracts, because obviously you have an appraisal contingency on a lot of these things, but we're definitely, it's already here. It's a done.
I think that's a good question to send to FAR if maybe the wording on the contract should be a valuation, lender's valuation requirement versus appraisal contingency.
Correct.
Because at the end of the day, it's your valuation. If you're satisfied with the valuation, you know. So we're getting a question. There's a couple of questions that are coming. One of them, and anybody watching, listen. There's a little place where you can ask questions. If you have any questions for me and Ruben regarding anything, this is the moment to jump in because we're getting close to wrapping this up. But the question is, if someone is on the contract now and the loan is sitting a CMG or anywhere else, do you think that it's still going to close on time, or is it going to be a delay? Is it going to be is the current remote working conditions going to affect that loan closing in place?
Well, definitely we're closing on time. Right now we do everything remotely. Our closers are remote. Our underwriters are remote. So yeah, this where we're at right now, there is no delay in our closing for closing dates. Now, obviously, not just us, but the industry as a whole is pretty busy. So new stuff may take a little longer, especially if it's a refinance. But yeah, we still see. I see Jennifer asking. We still see closings between 30 and 45 days to be the standard. Absolutely.
Okay. So this is the question that I've gotten a couple of times. Is regarding market values. If you guys internally have had any conversations regarding market value decrease. I mean, I know I touched on it. For you, for the ones that were here in 2009 and 10, at that moment, and on any industry, is inventory determines value. It's inventory what determines value. So you need to have, an uptick on inventory for values to decrease. Has CMG internally had any conversations? Are they concerned about values in South Florida going forward, or it's all normal going forward?
As of now, we have not had any conversations or changing our valuation process or our loan to values, which really would be affected right now. That would actually come from a higher level, because it's really the government agency that kind of run the LTVs. Mm-hmm. But prior to what's been going on the last couple of weeks here, yeah, as a matter of fact, we're doing smaller LTVs every day. So yeah, no, I don't see anything as of today, unless this thing really affects, like you said, the numbers, the inventory levels, and it may happen, and there's just no way of knowing.
Yeah, I mean, that's a conversation, believe it or not, because you're going to think about the effects of 2009 when that really fell into summer, April 2009, which is when Lehman collapsed. We really didn't begin to feel it into 2010, summer of 2010. So it took a year for that to work out through the system. A question I'm getting, and I'm going to answer, and I'm going to let you jump in, is, hey, I'm under contract right now. My buyers are panicking. What can I say to these buyers to get some sanity and some peace of mind and on their heads with their contract they have in place? My wording is simple. Listen, if you made this decision on logic to buy this property, it's because you sat down and did the numbers. You were either you were living somewhere. You weren't living out of your car. So if you were living somewhere paying rent, if you're gonna go back to rent, if there is a change in the market and there are more people looking for a place to live because they cannot buy, I mean, rentals are going to uptick. So if you're still going to have a place to live. So if you already committed, you make a decision on a moment that everything was logic. I don't second guess your question. I think that if you're still going to have a place, you're still going to need a place where to live. So, and with rates right now, check with Ruben. Maybe they can get you a better rate if you reach out to them. But you made that decision on a moment that it was logic. The past 72 hours, it's not been logic. The stock market, by the way, it's not the economy of the United States. A lot of people think that the Dow is tied to the American economy. It's not. And if you don't believe me, start asking how many of your friends have $100,000 on the stock market right now, or had $100,000 plus, and you're gonna see that the Dow, it's an index, it's not a pulse. What you gotta look at is it's consumer sentiment and unemployment. To me, that is what drives the American economy. So those numbers are still strong. So you still need a place to live. If it's the right thing for you, your job security is there. Stick through that contract. So, Ruben, what would you say to someone that it's having second thoughts today, willing to lose a deposit because they're watching everything that's happening out there?
Yeah, I would echo exactly what you said. I mean, if they made their decision based on logic, or they thought through their decision, then this shouldn't really make a difference. Again, most of what we've been doing the last few years is primary residences, so they still need a place to live. If it makes sense, I'm sure they're getting a good rate. So therefore, they're almost, the rates aren't going to be any lower. So it is a good time to buy in that sense. As far as pricing and values going up and down, again, that's nobody's got a crystal ball. But for the controllables, right? That's what we make our decisions in life, things that are controllable. And right now, if they have a rate that's fixed and locked, that's controlled. And if their decision for their primary residence was logically thought out, I think they should probably go through with it.
Another question we had was if I see the market shifting. So the market is always moving. I mean, if for someone like me that's been sitting here for 26 years, the market is always moving. That's why it's called the market. It's not stagnant. It's we're not Japan. We don't have a stagnation of a market. Yes, there will be listings that are gonna get repositioned to be moved over the next 60 days. Yes, there are unfortunately people in the industries that are currently affected, but it's to forecast that is going to happen. It's really sort of for me to just take a stab at something that may or may not happen. You gotta have faith in our government. For example, Germany is acting very strongly to maintain and prop up their economy with a couple of programs in place. I know that Congress it's working on something large, very large, to maintain the economy, not to maintain Wall Street and the Dow, to maintain the economy. So. But yes, there will be maybe an uptick on listings, which, like I keep saying, you need inventory. You need those 6 to 8 months of inventory. So we have a normal 3% to 3.5% appreciation yearly, because salaries go up 1 to 2%. So you want people's salaries to upkeep with appreciation so they can buy. We cannot have a 20 and for example, and I always go back to the city of Sweetwater had a 28% appreciation last year in values. There are no salaries that went up 28%, right, Ruben, that you know of?
No, nobody I know of.
Yeah. So you need a normal balance of inventory, and then that will quantify the market value. And the other question I'll defer to you. They're asking, that there has been, they think that this current Corona situation may affect home insurance policies. And as it is, our policies in South Florida are a little bit higher in some areas. For example, where me and you live, east on 95. Have you heard anything on that end, or?
No, I have not specifically to the coronavirus situation now. There is some talk that there is going to be a replatting of flood again. So that may affect some areas, kind of like where we live. But beyond that, nothing as far as insurance and this new issue with the coronavirus.
So if you're working, if you're doing your buyer consultations, if you're meeting that buyer face to face or via Zoom, and by the way, if you're using Zoom, you can be in one screen, your lender could be in one screen, your title can be in the other screen, and therefore you can have a pleasant conversation. I think you can. IMAP is a great tool to look at flood maps, but if you want to just try to have a guideline, if you're east of 95, you're going to have a higher flood insurance and wind coverage. That's simple. And believe it or not, and if you're all the way west of 75, you're also going to be the same. So somehow that middle ground of 75 or Turnpike and 95 is where you find the most affordable insurance. And believe it or not, where you're finding the most affordable homes right now. So do you see new construction slowing down? I know you guys represent a couple of large projects exclusively as the in-house lenders. I mean, I know it's only been 2 weeks, but has it been any difference on traffic or was it still the same? Open
Yeah,
house is
no,
still happening this weekend
yeah,
and everything?
yeah. I mean, and I know some of your agents are having open houses this weekend. So
Yeah, we
yeah, I
got
mean,
about 10 going over this weekend. Yeah.
it's like everything else, right? The whole life is like a bell curve, right? You get some people go a little extreme, some people go up there, and you average in the middle somewhere. But no, we haven't seen really any different. The phones are still ringing like crazy. We're getting contracts every day still. I do business with. I got 7 contracts yesterday. So I mean, it's. I don't know if it's lagging from the previous week. Again, this does take a little bit to kind of the market to absorb this situation, and then we'll see. But as of yesterday, at least, no, we haven't seen any, issue with as far as volume. We'll see. We'll see how the market absorbs. We
Yeah.
know.
So for those that are thinking, hey, it's new construction going to come to an end. There was the Delray Beach Golf Course closed yesterday for I think it was $20 million for 120 acres. That is a large tract of land that is going to be built into single family homes. There is yesterday in the middle of all of this, there's a huge rental project, rental, live, work, and retail in Little Havana, our old stomping ground, Ruben, that broke ground yesterday. There was 2 large projects that got funded yesterday to continue constructions. I listen. You got to put this 2 weeks in context. There's a lot of stuff thrown on everybody, but everybody that's been around this for a while, understands that when something like this happens, there might be a breather, but after the breather, you come back. It comes back. So I mean, so the projects you represent exclusively, they're going whole. Nothing's changed.
Yeah, well, we're not exclusive. Let's make that point. But yeah, the volume still seems to be at the same pace it's been all along. So, again, we'll see what happens. Like you said, there's going to be a little bit of a delay in processing this. But, I think right now, from what our numbers show, as of yesterday, volume's about the same.
Okay, last question before we wrap this up. Do we foresee rentals going up higher with the current crisis? And the answer is yes. Broward County had a 16% increase in prices and rentals last year. And for those that know me and are watching, I always say, do you know how much interest you pay in a monthly rental? 100%, because everything you're paying is interest because you're not amortizing anything. There's no money that you're putting away. So when you're renting, you're paying 100% interest rate. So yes, I think there will be an uptick in rentals because some people are going to be afraid to buy. They're going to flock to rent, and rentals will keep going up. And last question, Ruben, before we say goodbye. So first-time home buyers is a big part of this market. And I know CMG is very active in that. Do you guys have any incentives to assist these first-time home buyers into making that dream a reality?
Well, we're really all in on our home funded product where we match what they raise 2 to 1 up to $1,500. So that's kind of really where we want to work, especially with your question about the rental market. You know, we're always got to be thinking about what we're closing today, tomorrow, but remember, we got to think about what we're going to close next year also. You're always planting seeds, and at some point next year, if you get somebody who wants to rent, they're going to want to buy next year. So putting them in the home funded is the best way to get them to start saving money. We pretty much lock them down to work with you as a realtor and us as a lender. And obviously, we do have the $1,500 that we will, up to $1,500 that we will donate to their campaign. You know, they say, you know, tough times don't last, tough people do. So what I'll tell you as we sign off here, just, you know, if you have some time and you're bored of watching Netflix, you know, here's a time to learn that one more thing that you have been wanting to learn all these years, and read that one book that you have been putting off, just to make yourself better.
That's a great closing tip. Ruben, what's the number that everybody watching, because there's a lot of people watching and it's being shared everywhere, that they can reach you? Because I know that you do answer the phone. So where can you be reached?
My direct line is 954-661-2790. Call me anytime.
To everybody watching, it's been a pleasure. Stay safe. Wash your hands. And I'll see you not this Friday, but next Friday doing this. For all Canvas agents that are watching, if you ever want to request a little powwow with me, you know, you can just reach out to the office and they'll coordinate it. But remember, I do the rounds around the offices. So thank you for watching. Have a great rest of your Friday the 13th Friday, and a great weekend. See you guys around.